Hey folks, welcome back to the channel. This is Jason. How is your day going? And well, if you're paying attention to the stock market, the day is going fairly well. Today's actually going to be a little bit of a short presentation today, as I do have to do for some folks, and I'm going to get on that right after I'm done with this live stream. But I did want to talk about kind of what's driving market sentiment right now, and it's a couple of different things. And I want you guys to sort of pay attention to what's going on a little bit further on the horizon too, as I don't think that market volatility is done with. Although we may have a few weeks of really good market, at some point the debt limit becomes a real fight, and it can be reserved to basically be a theatrical show right down to the wire all the way into July before that really happens, which is going to hurt people who aren't prepared to just sort of ride it out. Okay. I urge you guys not to make any sort of rash decisions between now and the end of this debt limit fight. I know there's nothing right now. It doesn't seem like such a big deal. Trust me, it's going to be a big deal later on, because it's always a big deal when this debt limit fight comes up. And it always hurts a lot of individual investors who sort of imagine the worst thing happening. But as far as what's driving the market right now and good results, it's really this sentiment that nothing is as bad as we imagine it to be. I almost hate to admit this. I think that, because I really don't like admitting when the Fed sort of gets things right. They've been talking about a mythical soft landing since the beginning of this inflation crisis, since they really kind of pivoted and said, okay, it's not just transitory. We need to start fighting embedded inflation. And the idea of a soft landing has always been mythical, because it's never really happened when that is what the Fed intended. Okay. Now we've had a couple of soft landings. And what I'm really thinking about is 2018, when the fixed income market almost collapsed. And that's something that's not remembered by today in 2023, and particularly new investors who haven't had any interest in the fixed income markets at all. But the Federal Reserve rescued fixed income markets in 2018 and backstopped a couple of different products and lowered interest rates again. And that sort of created this soft landing where we didn't really have a recession in that time period. So what we were probably looking at here in terms of a best case scenario is an earnings recession for Wall Street. Even if we didn't really see the sort of decline in GDP, we're probably looking at an earnings recession. Right now, though, even that is looking a little bit unlikely. And let's talk about that, because last week, beginning on Monday, was really the beginning of earnings week. It's really starting to pick up steam this week, and the story has been relatively consistent. And I want to bring you guys a look at some of the things that we look on this channel, but a lot of other YouTube channels aren't covering, which is what our financials doing right now. And let's talk about that. So I think Synchrony Financial came out today. The earnings beat on loan growth. And this is kind of the story all around, is that the financials are showing some challenges, but in the main, they're either meeting or exceeding expectations here. And this is also the big story. So net interest income for SYF amounted to $4,106 million, which is $4.1 billion, improved 7.2% year over year. That's 7.2% on $4 billion, right? Top line beat consensus mark by about 1.7% and came in higher than our estimate of $3.9 billion. The quarterly results have benefited from rising loan receivables portfolio, paving the way for higher interest and fees on loans, meaning we're going to see a greater spread between deposit operations and loan operations, and we're going to see fees start to expand on that. We're also going to see something very interesting here. And yeah, Michael Will says, evening, Jason, sporting a nerdy look today. I wear my reading glasses a lot now. These are, and my eyes are a little bit more tired. I think that all has to do with age and the fact that I haven't been getting very good sleep lately, but mostly to do with age, guys. Loan receivables are improving, interest rate spreads are improving, and fees are going to start expanding. And they're actually seeing a growing purchase volume on loans, resulting from increased contributions, not just on loans, but from 5 sales platforms that also contributed to the upside. So this is Synchrony Financial, which is not a small company by any means. When their interest income is in the $4 billion range. So, yeah, other income from Synchrony Financial plunged 82% year over year. What really isn't understood here is the decline is due to elevated loyalty costs. I mean, the cost to keep customers. But last year they had a gain on investment, on a venture investment. I mean, they basically sold off a company that they owned last year and made a giant amount of what's termed as other income. So total loan receivables, this is the real business, were 92.5 billion, which rose 14.5% year over year and beat estimates of 89.9 billion. Total deposits advanced 15.2% year over year. So what's going to heat up now, folks, is the battle to get deposit dollars, because now that the loan facilities from the Fed have been tightened up, it's going to be cheaper for them to generate the money to create loans from loan deposits. This is, a company that I talk about a lot, that's gotten a lot of attention lately, is SoFi. And this is something where they are going to actually go gangbusters this year. They, I think they received about $8 billion in deposits in Q2. I think it was a similar amount in Q3 that they expanded their balance sheet by. And they haven't even started issuing CDs. Now they issue brokered CDs through their brokerage account, which they get paid a commission on, basically to sell someone else's CD. But that doesn't go to fund their deposit operations, which in turn are used to create more loans. You can look for SoFi to actually issue bank CDs sometime before the end of the student loan moratorium. That's going to lower their borrowing costs pretty greatly. So a lot of other banks now are going to be fighting for those deposit dollars in a way that they haven't done so in the last 13 or 14 years, where because there was no real incentive, to go from one bank to another just for, 0.1% in terms of difference on interest that you're making. If you don't have a couple $1,000,000 in the bank, it doesn't make a difference. That's all changing now, and you're going to see that urge to move based on smaller and smaller deposit amounts because of the difference in deposit rates. And traditional financial institutions, large institutions, are going to be at a disadvantage. They will only pay these great rates on new deposits for the most part. That's how their promotions have worked, because that's what they're looking to do, which is improve their deposit base on where they were last year. So basically, everything up there was pretty great. The net interest margin of 15.58% deteriorated by about 19 basis points year over year. You can look for that to start increasing quite a bit here. If the Federal Reserve decides to raise interest rates a little bit, there'll be a little bit of a lag in that margin before it catches back up. New accounts totaled 6.4 million, down 13% year over year, and average active accounts of 68.4 million dipped 1% year over year. I suspect this is a large sort of traditional bank. That is probably due to competition from other banks and most likely fintechs as well. So State Street also, this is a very solid met expectations, in line with expectations. Revenue was flat year over year compared to 2021. This is despite all of the challenges that financials had. Net income was up 3.4%, and profit margin was 22%, which is in line with expectations. So basically, no surprises here. Upside, no surprises on the downside. I didn't read through this particular financial report, so I'm kind of relying on what Yahoo Finance says. I did look at Synchrony's financials. So Ally is a bank that I hold a few shares in, just 100 shares, so not a ton. And the shares of Ally Financial gained 20% following its fourth quarter and 2022 results. Actually began before that. That run up began before that. This article is not correct. So that 20% run up happened over the course of about a week and a half. So the bottom line reflects a decline of about 46.5% year over year. So this is a solid bank that is down about 46.5% year over year. I'm comfortable with where I bought this stock. I bought it on a sort of 7 to 10 year time frame, just being a solid financial provider with a lot of room to grow. I could have taken all this money and dumped it into SoFi. I elected to sort of divide my risk in the financial sector. I tend to invest pretty heavily in the financial sector when we see a rising interest rate environment, or when we look at going into a recession. These types of financial companies, large financial companies, tend to do very, very well in a recession, come out looking very strong. So after non-recurring items, net income available to common shareholders was 251 million or 83 cents per share, down about 624 million or $1.79 per share prior year quarter. Our estimate metric was 305.4 million. So a little bit of a disappointment in that. So adjusted earnings per share was 606, down from 861 in 2021. So we do have a little bit worse performance than, or actually substantially worse performance in 2021, but not necessarily outside of expectations here. Expectations here on the downside. It's actually outside of expectations on the upside here. People were expecting this company to do worse. And that is kind of the story right now going on all across the stock market, is that at least in not just financials, but oil has done very, very well this year. And that's in line with expectations, mostly due to oil price and volume. But financials doing well, meeting expectations or moderately outpacing expectations is not something that was expected. And that in part is the Dow Jones up 254 points today, driving the 800 up 47 points. And of course, tech is coming back strong. So tech is simply more volatile than the rest of the stock market in general. Expect those highs to be higher and those lows to be lower. If you got the stomach to be in it, it's a great place to be. So I'm open to answering any question today, but did want to talk about a few things. Tesla has actually absolutely going gangbusters over the last couple of weeks or so, up about 35% or so. Today closing at 143.75. The big story for folks that watch my channel, of course, has been SoFi, which is up roughly 30% or so, from 440 a share up to 587 a share. I expect that to be over 6 and to stay over 6 by March or so. The only caveat there is that it's really sensitive to macro environment. You cannot look at anything in terms of the company fundamentals and say it's not executing on the plan that they said they're going to execute on. And the plan is probably a lot bigger than you guys think. I'm working on a video right now where I'm going to talk about their technology arm and how they're kind of looking to be the Amazon Web Services of fintech. Like, it's already gotten to the point right now when it comes to SoFi's background technology, that if you're a fintech getting in the business, it probably makes a lot more sense to sign up with their platform and have instant access to cyber banking, have instant access to products like lending products, credit cards, buy now, pay later, credit card services, all that stuff. You're basically using an API, writing a front end for your app, and you could probably do it in a weekend. Like, literally, you could get your paperwork from from your state government or whatever that you need to in order to register your company, slap together an app over the weekend, and be in business before the ink dries on your contracts. And that's literally a line from the video that I'm kind of writing out right now. It's going to be that simple for people to get started in fintech, where they won't be reinventing the wheel. All they're going to be doing is figuring out how to market their clients and to design new, dynamic, and flexible products using the Technisys and Galileo platform, which will probably be what I envision. Actually, is eventually it's going to be Technisys and Galileo will be merged at some point. They're going to be a strong enough separate division in SoFi that eventually they'll probably separate it from bank operations. We'll probably see SoFi lending, bank operations, and financial services as one arm of the company, and probably a wholly owned subsidiary for the technology services. Ideally, what I'd like to see is not for that company to get bought out in the future, but for that company to break out and to go to IPO itself, and then we all get a share payout in that as long-term holders of SoFi. So that's kind of one of my things there. So looking through lots and lots of financials, there were a few misses in terms of financial stocks, but the misses really weren't all that significant. And there were a bunch of met expectations, and actually a bunch of people that mildly exceeded expectations as well. I'm actually looking forward to witnessing my first actual planned soft landing from the Fed. I don't want to say that it's going to happen. I don't want to say that we won't actually have 2 consecutive quarters of declining GDP here in 2023, because there are a lot of so-called black swan events, as Chris points out. We could have black swan events from the Ukraine war. So here's what I think about the Black Swan event, depending on the Ukraine war. Um, Whatever Putin's strategy was in terms of taking over Ukraine, getting closer to the Bessarabian Gap to sort of plug that invasion route into Russia to realign the world in terms of a unipolar world in order to realign geopolitics, that has failed utterly. Um, he could win in Ukraine. I think that's still a possibility. I don't think it's a distinct possibility anymore. I think it's a remote possibility that Russia will win in Ukraine. But estimates are now that the Russians may have suffered 188,000 to 200,000 casualties at this point. By the end of a spring offensive, I fully expect that to be over 300, 350,000. At that point, I think the pressure starts to build on Putin, and no matter what happens, he's not able to sort of realize the greater ambitions of invading Moldova, taking out Poland, Lithuania, Latvia, that sort of thing. Finland joins NATO, Sweden joins NATO. At that point, I think that at that point, I think that the idea of this being a domino effect is pretty much done. Western unity has really ended that possibility. He still has a lot of potential to disrupt oil markets, though. I actually fully expect oil prices to rise here in the next couple of months, which will put a little bit more pressure on the Federal Reserve in terms of interest rates and in controlling inflation. That's not going to be replaced by domestic production of oil, although we are seeing an increase in domestic production of oil. We are seeing a decrease. Well, actually, don't quote me on this. There was a prediction that there's going to be a decrease in exports of oil products here in the United States to other countries. So, yeah. Hal says all this might be positive for Block. I think all of this is going to be positive for Block. Block has a bunch of pieces missing in terms of what SoFi is doing, and they're also going after a very, very different market. So, one of the most interesting things about Block is the really, really low cost of customer acquisition. The Cash App is basically just awesome, but they've really gone after the unbanked, which you do a little bit of business with the unbanked, but the idea is that if you lay over a heat map on Cash App adoption with along with basically a heat map of the unbanked, it's almost a perfect overlay, right? So you don't make a ton of money off of the unbanked when they start using the Cash App, but you do make a little bit. And the idea is that you can take a lot of people, take a little bit of money from them, and it's a very profitable way of doing business because the cost of acquisition of customers is very, very low. But there's a limit on the extreme level of poverty, basically, of how much you can generate off of these folks. SoFi, on the other hand, has been able to build a business apart from student loans. It's no longer the largest portion of their. It's going to be the largest portion for revenues for 2022 as a whole. But when you look at third and fourth quarter of 2022, you see that student loan origination is less and less important as a business. Personal loan origination is growing, and bank operations are growing. Block doesn't have bank operations. Block's big money maker is Cash App, and of course, their business operations. So I don't look for SoFi to compete on payment processing and business operations with Block for quite some time. And let's remember they have a couple of other competitors in that space right now, like Toast, which one of my businesses uses Toast, and it's absolutely fantastic. But Block doesn't have the sort of one-stop capability that SoFi does at this point, but they do have a strong business model, and they're not going to benefit from a lot of the deposit operation stuff that SoFi is going to. And but yeah, so they're just very different businesses. It's hard to compare one to the other. There would be a reason to own Block because they're exploiting that unbanked sector, and they figured out a way to make money from unbanked folks. And they provide a real good entry to payment and simple entry to payment processing for small businesses. That's been around forever. Their blockchain business, on the other hand, I have no idea when that is going to make a profit for Block. No clue whatsoever when that's going to be really, really good. So Shula Joe says, does that mean there could be a flood of new fintechs on the back of SoFi Galileo technology offering? Yeah, I do think so. I do think, though, that investment in new fintechs is probably going to be pretty slow in the next year and into the year after that, 2024. I think that real maturity of the sort of Galileo Technisys SoFi platform probably comes by year 2025. Even SoFi is not entirely on the Technisys Galileo platform. They operate across 4 or 5 different platforms, and they're working to integrate those into a single package at this point. I say that I just know from working in finance and working in software development that it's not going to happen right away. It really is going to happen right away, and eventually they're going to have competitors as well. But they're going to have a huge first mover advantage when it comes to other fintechs. There isn't going to be the incentive for them to go out and develop something from the ground up. The people that do have the funding to develop something from the ground up are, your Goldman Sachs or your Wells Fargo, which are based on like 1960s mainframe and COBOL technology. And I think that's going to be there's going to be a huge difference in the level of sophistication that what SoFi offers versus what some of these larger operations offer. And you really need to look at Technisys platform and how they have sort of this dynamic product design program that they have. And I'm still looking into this right now. That's why that video I'm making right now isn't complete. So yeah. So the U.S. has to replace the 218 million barrels of oil if they want to get the SPR back to where it was. But as you explained, they don't need to replace it all. No, they don't. There's not a mandate to replace it all for security like people think there is. The Strategic Petroleum Reserve is really about maintaining price stability. That's what it's about. And there's this, everyone thinks that it's about, oh, well, what if we go to war and we need that oil for, we would use that oil up in the first couple of days of a war, or first couple of weeks of a war. And that's it. So the United States has never produced all of the oil that we need. Even if you look at calculations that say back in this time period, we were energy independent. Energy independent does not mean that the United States was producing enough oil to power all of our oil needs in a day. It never meant that. It's a complex calculation from oil derivative products that we export, energy that we export in terms of oil that we don't use or don't have the refining facilities for. It's just far more complex than like media wants you to think it is. Oil independence is a myth created as basically it's like it's keeping score, and it doesn't really mean anything beyond that. I would love for us to get to the point where we are producing all of the energy we need in a day right here in the United States, and we're exporting oil distillates and oil products like petrol, like plastics and things like that. But that's not going to happen, maybe ever. But yeah. So Michael Will says the job market and housing market currently aren't indicating recession. That's true, and even with all of the announcements of job cuts, we aren't seeing a declining economy at this point. So basically, once there are under 300, if there are still under 350,000 applications for new unemployment benefits, it means that that employment is still growing at this point, and we're not in recession. That's sort of a trailing indicator of recession. And right now, we still have under 200,000 new jobless claims. I'm not looking at recession or even the beginnings of recession in terms of an all-encompassing view of the economy until we're at north of 350,000 jobless claims per week. So, yeah. Let me see here. Hi, Jason. Everyone in chat, need some suggestions, please. So one of my suggestions here is to play it a bit safer at this point in the market. Like, I know that it's been tempting to look at what technology has done in the last month or so, where a lot of our favorite stocks are up 30 and 40%. Some of that was just a snapback from being oversold. I would really start looking at companies that look undervalued based on current cash flows. And right now, your opportunity in that is in financials. And it's in some of the bigger, more boring financials. Okay. Some of them have seen some moderate declines in business and have been punished by outsized declines in stock price. Right. And I think that's where your better opportunity exists. Let me see here. Hi, Jason. Happy Tuesday. Off to do some IT work. Interesting in Australia at the moment. We're seeing a small buy now, pay later fintechs actually reporting profits for the first time. And interestingly, so Galileo actually just started the buy now, pay later with SoFi as well. And that's a product that's not available just to SoFi. That's available to anyone using the platform, which is going to bring in money as well. I would love to know which companies in Australia are actually seeing buy now, pay later profits. And let's remember, these folks that do buy now, pay later, they're going to benefit from higher interest rates as well. There was a question I wanted to answer here. It's a little bit further back. Do you own Google, and are you concerned about Chat GPT? I don't know what you mean by concerned about Chat GPT. So Google is rushing right now to get their own chat search bot out to market. In fact, there was an article on uh, I think it was on Barron's. Talking about the same thing. And Microsoft, of course, just announced an initiative to invest billions into OpenAI in a quest to beat out Amazon and Google. So ChatGPT is getting a lot of press right now because they're really kind of a first mover on this, but they're just not the only ones in it. I wouldn't go overboard right now investing in AI and individual AI companies. Invest in the infrastructure. NVIDIA is going to be a good place to be. AMD is going to be a good place to be. TSMC is going to be a good place to be for the next decade to benefit from AI. So, how is ChatGPT monetized at this point? That's a answer. We can't answer that question at this point. How is Google going to monetize it? We know exactly how they're going to monetize it, and it's going to be by advertising results. But I don't know how it's going to be different than the way they monetize their advertising results right now. Hopefully, they come up with something different. So I'm not incredibly concerned right now because no one has actually monetized it at this point. That's coming down the road, but we're also going to see a lot of competition out there. And how did Google become a verb, right? Google was a company, but now we Google things, right? And like we haven't reached the point where we chat GPT things yet. We haven't reached the point where someone has seized that real estate in the consumer's mind. And I think it's going to be a while before that actually happens. Look how long there was a real business in search, right? There was a real business in search from say like 1998 in the Yahoo heyday, and then they had like Lycos as a competitor. They had what was it, Hasta La Vista dot SK. That's probably something you don't remember, or no, just Hasta La Vista out there. They had a number of different competitors that were out there, and then Google emerges right around 2001 as sort of like the big thing. And by 2003, that's really satisfied, and you no longer search for things, you Google things, right? I think that eventually happens with Chat GPT, with chat search, with Chat AI search, but there isn't a way to predict that at this point. But why bother predicting it? I'm going to invest in the hardware infrastructure that all of these software companies are using, and a lot of that is going to be NVIDIA. And NVIDIA has been setting themselves up for this for like 6 years now. They've been setting themselves up for this AI revolution that doesn't seem to have happened yet. And it looks like we're kind of on the cusp of that now. So I'm not concerned with Google. Yes, I do own Google, but I'm not concerned with ChatGPT for the moment. Like I said, early days, guys, early days. Okay, let me see here. Uh, so I need a new car. I have savings, or I could sell some of my investments. I know this isn't financial advice, it's my decision. Would you consider using savings to do a purchase? So where you are, I don't know what your requirements are in order to buy a vehicle. I don't know if you own your own business and you can deduct some of that as a business expense, or at least deduct the interest on as a business expense. I personally tend to buy used cars for like dirt cheap and just drive them till they die. I spent $4,000 on my last car in 2020, and I'll drive it till it dies. I spent $5,000 on a car before that in 2008, and it actually hasn't died yet. Now I just use it to tow my boat. But I have spent well under, I'm almost 50 years old, and I've spent well under, say, $60,000 on cars in my entire life. That includes repairs and maintenance. Most people my age can't see that because they spend a lot of money on car. I see it basically as just wasted money. I just want a car that's reliable, that gets me from point A to point B. If you can put enough money down on a car and it still leaves you 3 to 6 months of living expenses in cash, which I keep a lot more than that in cash, guys, just because I don't know what my earnings potential is going to be in the next 2 to 3 years because I'm self-employed. But there's nothing wrong with financing anything, but there is something wrong with financing something if there's no advantage to it, right? meaning if you don't get a tax deduction on the interest that you're paying, you can't deduct part of it as a business expense. Or if you're buying a used car and financing it, there's not a lot of reason to do that. If you're buying a new car and financing it, you got to ask yourself why you're buying a new car to begin with. I think that when I think you're closer to younger guy. Buying, and for younger folks, buying a new car is one of the easiest ways to actually kill your wealth. And I know what the temptation is. Like my first couple of cars just sucked, and I was constantly pouring money into them to repair them. And then I ended up buying my one and only new car and regretted it, man. I really regretted it. It was just a giant expense. I had to make that payment every month. It was like $450 back then, which probably doesn't sound like a lot, but and I put very little down. And at the end of it, I had something that wasn't worth all that much, right? In ever since then, all I have bought is used cars that are reliable, and that is it. Point A to point B kind of thing. But I would only use cash to purchase the car if it still left me enough in my savings account to cover 3 to 6 months of expenses. I would not liquidate any investments to buy a car. I definitely wouldn't do that. Here's one of the ways that you could do that. You could sell some extremely long range, well out of the money calls on a stock that you are willing to dispose of at a certain price. Meaning that if you have a price target on a stock that's say $100 a share, it's like $70 a share today. You may be able to sell a call on that stock, a year, 2 years out, which is basically a leap contract. It's not in the money, so it's not a leap contract, but you may be able to sell a call out a year, 2 years out, pretty far out of the money, and still generate enough or enough income from that premium in order to put down on a vehicle. And you're guaranteeing yourself a disposal price that's well within the range that you want to sell this stock. That's an avenue that you could take. So yeah. Okay. Did I miss any questions? Did I miss any questions here? Let me see. No, I don't think I have. And this is about all I wanted to cover today, guys. So I'm going to go ahead and get off. Been on for half an hour. This is one of my shorter live streams. Didn't want to thank you guys for coming today. And I will be back on Thursday. And I'm going to hope to get out my video on SoFi by Wednesday or by Friday. Earnings for SoFi is on the 30th. So what I'm going to do there is kind of break down where I see SoFi going in the next year and a half. Of course, I'm not going to do price targets because I don't do that. But this is a long-term hold for me. I'm really underwater on this stock, and I have no plans of selling. So that tells you what my confidence level is for this particular stock. But I'm going to present it in a way that's fairly neutral, or as neutral as I can be, despite the fact that I hold a lot of shares of the stock. And I'll let you guys make the decision. The reason I'm doing this is because there's a lot of company or people out there now that have kind of moved their YouTube channels to being almost exclusively about SoFi, right? Where they used to cover other stuff, because I went back and looked at them. Now they almost cover nothing but SoFi. And sort of this greater attention on SoFi has me wondering if some of these people aren't sort of like paid promoters. So I want to take a look at claims. I want to take a look at rumors. I want to take a look at results and kind of like give you guys a preview for what's coming out on the 30th. But like everything else in the financial industry, I expect them to have at least met expectations. To be honest with you, I expect them to kind of have a blockbuster quarter as a fourth quarter. And a lot of that's going to be driven by the increase in membership, which was driven by the increase in deposit operations for their high yield savings account. So yeah. Anyway, I will see you guys on Thursday for sure. And I look forward to seeing you next time. Thank you very much.